Warren Buffett still doesn't like Bitcoin. In a CNBC interview nearly 8 years ago, he famously stated that cryptocurrencies would come to a bad ending. While that prediction has proven accurate for many crypto projects, Bitcoin itself shows no signs of such weakness. Quite the opposite. Bitcoin's price has risen from roughly 90 cents in 2011 to around $95,000 today, representing an extraordinary multi-million% increase. Bitcoin's price behavior is highly cyclical. These cycles have repeated with remarkable consistency over time. In June 2011, Bitcoin peaked near $25 following a sharp rally. After a steep decline, it took almost 2 years for the price to return to that level, which it finally did in February 2013. Later that year, in December 2013, Bitcoin reached approximately $1,000. That level was not revisited until February 2017. By December of the same year, Bitcoin surged again, this time to nearly $20,000. It then took roughly 3 years until December 2020 for Bitcoin to reclaim the $20,000 level. In 2021, the price continued higher, eventually peaking near $65,000. This repeated interaction with prior peaks and throughs highlights a clear pattern of support and resistance behaving in a smooth, cyclical manner. Based on this historical structure, it is reasonable to expect the price to continue respecting these long-term trend lines. As of January 2026, Bitcoin is trading near $95,000. From a technical perspective, the price could go back to the $65,000 or $70,000 level, and if that holds as support, history suggests it could start another major rally. At Gleneus, we're always focused on providing you with outstanding analysis. However, none of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Yes, we said Buffett doesn't like Bitcoin, just like he doesn't like gold. However, the reason many retail investors are so drawn to Bitcoin and gold is not only its strong historical returns, but also the belief that it offers protection against what is often described as US dollar debasement. A commonly cited illustration is the long-term decline in the purchasing power of the US dollar over the past century. When adjusted for inflation, the dollar has indeed lost significant value. A dollar in 1915 could buy roughly 25 times more than a dollar in 2020. In other words, the dollar lost about 96% of its purchasing power over that period. However, interpreting this long-term inflation trend as evidence of currency debasement is a misunderstanding of basic economic principles. While the purchasing power of the dollar has declined over time, as is expected in a growing economy, there is no indication of a systemic collapse or loss of confidence in the currency. If genuine debasement were occurring, we would expect to see major global institutions aggressively reducing their exposure to U.S. assets. That is not happening. There has been no mass sell-off of U.S. treasuries, nor a meaningful withdrawal from U.S. equity markets. When Bitcoin's price is overlaid with the dollar index, a strong inverse relationship becomes apparent. An inverse correlation means that when the dollar strengthens, Bitcoin tends to weaken, and vice versa. The dollar index peaked in February 1985, when the dollar was exceptionally strong before declining sharply. From the mid-1990s to the early 2000s, the dollar once again surged. The DXY reached its modern low in 2008, after which it has followed a remarkably consistent upward trajectory. A similar pattern emerges when gold prices are overlaid against the dollar index. As the dollar weakens, investors often increase their exposure to gold, reinforcing the same inverse correlation. In this context, rising prices of Bitcoin or gold do not necessarily signal dollar debasement, but rather reflect how alternative assets respond to fluctuations in dollar strength. The legendary investor is currently sitting on nearly $381 billion in cash, more than at any point in the past 20 years. However, the nominal value of the company's cash holdings continues to grow because the company itself is expanding over time and its cash position scales accordingly. What matters, however, is the cash as percentage of total assets. That value is around 31%, which is very high. Last time he owned similar amount of cash was right before the great financial crisis, sensing the stock market would collapse. At first glance, this looks contradictory. Why did Buffett hold so much cash when cash steadily loses value? As Buffett himself once said, the natural course of government is to make the currency worth less. But if we overlay the Dow Jones Industrial Average, we can see exactly when Buffett prefers cash over stocks, usually ahead of major market downturns. Historically, major market crashes, such as those in 2001 and 2008, were preceded by increases in Buffett's cash holdings. In both cases, he accumulated liquidity in the months leading up to the collapse and then deployed capital decisively after asset prices fell by tens of %. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaius.